This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set to extend Wall Street gains despite underwhelming earnings from some of the tech heavyweights. A weak reading on US services sending Treasury yields to 2025 lows. Holdings tumbling after the bell as a muted forecast adds to AI concerns. Ford warning of a $2 billion profit slide on tariff and EV threats. Investors are also bracing for fresh geopolitical shocks as China seeks US trade talks at the WTO and President Trump prepares to reveal his plan for peace in Ukraine. Just ahead of all of that, we do have some breaking data when it comes to South Korea's economy. This is a current account balance as well as the balance of trade numbers. We are getting the current account surplus widening to $12.368 billion there. The December goods trade surplus widening to $10.434 billion US dollars. And this is, of course, coming amidst a whole lot of trade uncertainty. Policymakers in Korea certainly very concerned about both domestic growth prospects, a weakening there with political turmoil, but of course also President Trump's ongoing tariff campaign, given that we do expect that impact on South Korea being such a externally vulnerable and trade vulnerable economy. So we are getting that widening of that surplus number there for December, Shery.
Yeah, we'll watch that market as they open in about an hour, but within that market is really the tech sector as well, because the government there has announced plans for a $23 billion fund to support battery and biotech stocks. But it's really about the tech stocks that could move in the Asian session as well. Of course, we do have Tokyo Electron earnings today, but we've also heard from sources that the SoftBank group is in advanced talks to acquire Ampere Computing. And you can see the Japanese yen right now strengthening a little bit at that 152 level, the strongest since December. We have seen that surge in yields here in Japan as well, given the strong wage growth data that we got this week. We're watching the offshore yuan as well. We had a little bit of pressure, not surprising given the U.S.-China trade tensions. But what we're watching is the overnight session on Wall Street as well, not to mention the after-hour session as well. You mentioned some of those stocks like ARM falling in the after-hour session, while Qualcomm is also rising on a bullish sales forecast. So we're seeing right now the Nasdaq 100 futures holding steady, while the S&P 500 futures also not doing much. We actually saw stocks rising, gains in most major industries overnight, but the likes of Alphabet had its worst day in over a year. And with yields falling, as you mentioned, the dollar also at the lowest level in more than a week. Crude prices holding steady. Of course, we have plenty of commentary coming from the Trump administration when it comes to the Middle East tensions.
Let's, Shery, get some more on the top stories that we're watching today. Bloomberg's political news director, Jody Schneider, joins us out of Washington. Our chief North Asia correspondent, Stephen Engel, is in Hong Kong for us, and Garfield Reynolds, who leads our Markets Live Asia coverage here in Sydney. Jody, let me start off with you. So we had, of course, the pretty brisk global reaction to the Gaza plan that was delivered by President Trump at the press conference with Netanyahu yesterday. We're now expecting to hear details of a plan to end Russia's war with Ukraine. This is expected to happen at the Munich Security Conference next week. What do we know about the positioning here and what he could say?
Yeah, this after, as you're noting, we had kind of that surprise, those surprise remarks about this Gaza plan, which were kind of roundly criticized in the Middle East today, except for Israel, which supported them. The president and this is according to people familiar with the matter, it has not been announced, but that the president will send Keith Kellogg, his negotiator on Ukraine, to the Munich Security Conference next week to lay out a plan to end the Ukraine-Russia conflict. What we know of the plan, and it's sketchy thus far, would be to basically try to pause fighting, that they temporarily, that Russia temporarily has some of the lands that it has gotten in the conflict, that this would end before, that this pause, at least in fighting, would end before the 3-year mark of the Ukraine-Russia conflict, and that both sides would go to the negotiating table. The U.S. would be involved in those talks. That's what we know at this point. More will be coming out, but this is something that President Trump has talked a great deal about, talked a lot about on the campaign trail, saying, in his words, that war would have never started under his presidency, and under his presidency, he will end it. Lots of conjecture at this point whether Ukraine would accept this, especially if they would be losing land or territory that Russia had taken over in this, and what kinds of requirements would they need to have before they went to the negotiating table. And we haven't heard from Russia yet on this either. We did hear, the only thing we heard from Ukraine on this today was that they have no comment at this time. Again, this is according to people familiar with the matter, and we expect to hear many more details about this in coming days.
And Jody, of course, as Heidi mentioned, we had also reactions from President Trump's comments on Gaza, both in the United States and really quickly from Saudi Arabia as well.
Yeah, Saudi Arabia, along with most other Middle Eastern countries, criticized this idea, which at this point it's not really a plan, it's more an idea, to displace or to have temporarily displace Palestinians from the Gaza Strip. There's almost 2 million people there, and send them to other countries while the Gaza Strip was redeveloped. This is something the Palestinian Authority came out and criticized today, and Saudi Arabia said it would basically be tantamount to a forced evacuation of people from what Saudi Arabia calls their legitimate lands. So this is something that is not flying well with leaders in the Middle East. Today, the press secretary in the White House briefing said that there would be no troops on the ground, no American troops to require this, and that American money would not be spent, or U.S. dollars would not be spent. But she did say that the president does mean for there to be a temporary displacement of the people who now live there. And of course, that sounds like that would be a non-starter with a lot of these other countries. We also did not hear from any Middle East countries that they would want to take the Palestinians, that they would take them on a temporary basis. Right now, they seem to be saying this is a non-starter as far as they are concerned with any forcible removal of people from the Gaza Strip.
Jody Schneider there joining us from Washington, Bloomberg's political news director. As we continue to watch the Middle East, we're also watching China increasing its objection to President Trump's 10% tariff, filing a complaint at the WTO that calls for talks with the U.S. Our chief North Asia correspondent, Stephen Engel, joins us now from Hong Kong. What do we know at this point about this action?
Well, China is simply following through on its pledge that it would file a complaint at the World Trade Organization. And in that filing, they said those 10% tariffs that you mentioned, Shery, were, quote, imposed on the basis of unfounded and false allegations. The measures at issue not only violate WTO rules, but are discriminatory and protectionist in nature. And it is seeking talks with the United States through the WTO mechanisms. But it's yet to be seen, given the Trump administration's more unilateral approach to executive orders justifying these tariffs. It will be an interesting development if the two sides would come together under the WTO. Still waiting for a potential phone call that the White House has said a couple of days ago could have happened within 24 hours or a couple of days. But yesterday, of course, Donald Trump sort of poured cold water on that, saying, I'm in no rush to speak with Xi Jinping, and also classified China's response so far as that's fine. And it has been a fairly muted response from Beijing so far after the enactment of those 10% tariffs. It leaves Beijing with some room, perhaps, to either negotiate or also roll out further measures down the road. Keep in mind, it's retaliatory measures that included some tariffs as well as export controls, and a couple of American companies added to the blacklist entities list. That takes effect February 10th. That's next Monday. So there is room there, perhaps, for negotiation. But keep in mind, Beijing kept the big guns to itself for now. Agricultural products like soybeans could have been tariffed like it was in the first retaliatory trade war action back in 2018. And then in that first term of the Trump administration, keep in mind, the soybean exports from the United States to China dropped 80% in the first couple of years, costing U.S. farmers about $11 billion. So China hasn't done that yet on the United States. I'm not saying they will. They have diversified their supply chain as far as sourcing from countries like Brazil. So they're building resilience into their sourcing. But again, agriculture on the sidelines right now. Also, keep in mind, remember, they announced yesterday, Beijing did, that they were launching an investigation into Google, which is sort of a muted point because Google has been out of the China market for 15 years. But now we're hearing that they could be launching kind of the framework for investigating Apple's policies. About the fees that it charges developers. The sources are telling us that Chinese regulators believe Apple may be charging local developers in China unreasonably high prices, and that barring a third-party app store and payment method also hinders competition and hurts local consumers. So watch this space for Apple in China as a potential lever of negotiation for China, or a lever for retaliation from China against those 10% tariffs.
Steve, we've also had this whiplash reversal from USPS as well, right? The Postal Service first refusing Chinese and Hong Kong parcels and then turning around saying that they've worked out a mechanism to collect those taxes.
Yeah, well, there was about 12 hours of extreme confusion about this because I saw the statement on the U.S. Postal Service website. It basically was one line saying they will, for now, temporarily suspending the receiving of all packages from China and Hong Kong. And keep in mind, this sudden move by the Trump administration to remove this loophole of this $800 de minimis exemption for small packages less than $800 into the United States, direct shipment that didn't require duties or inspection, really kind of threw the USPS into panic mode to figure out how they're going to enforce that. There were 1.4 billion de minimis shipments into the United States last year. It's about 4 million a day. So I think they really kind of panicked and said, how are we going to comply with these new rules? But it sent, obviously, online e-commerce providers into panic mode as well. And also, what about all those shipments that are currently going across the Pacific or elsewhere from around the world? So again, the USPS is saying, as of now, they are accepting all packages and mail from China and Hong Kong. But watch this space.
Always our Chief North Asia correspondent Stephen Engel there. Well, Asian equities are set to advance after we saw both stocks and bonds rising on Wall Street in a week that's been marred by tariffs, lackluster tech earnings uneven, US eco data. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, a period of extreme uncertainty, as Steve characterised it as. I guess that's going to be the next 4 years. But I guess we can see in this example with USPS how quickly the outlook can change for, certain segments and companies like e-commerce in China, for example.
Well, yeah, and you're sort of left waiting for the next shock that might come, including shocks that end up being extreme geopolitical or political shocks where there isn't any obvious market move that's attached to it. So it's a very fluid situation out there. And I think there's going to be an air of caution even as Asian equities rise now, because you don't know what might come next.
Yeah, here in Asia, of course, given the uncertainty, what we're watching is just trading by headlines. At least when it comes to the Chinese markets, though, what sort of reaction did we see after the open, given that also we saw a lot of consumption during the Lunar New Year holidays?
Well, we did, although there was some disappointments. I thought it was very noticeable that the services PMI that came out yesterday fell and missed expectations that it would hold up precisely because of Lunar Year Lunar New Year holiday spending. So and that was the first time since early 2003 that all 4 of the PMI readings for China fell. They also just about all of them missed expectations, or best case was they came in about the same as expectations. So that's a pretty grim picture, and it was focused on the services PMIs. Those were the worst ones. So amid that, there is an ongoing concern about China's potential to spur consumer demand. We'll probably see, I suppose, a recovery in some of those e-commerce shares that fell yesterday in China on the USPS news. But really what China needs, as far as the broad equity market investors are concerned, is concrete stimulus measures. They need, they're looking for some combination of rate cuts or reserve ratio cuts, concrete, large, targeted spending moves to boost consumer demand, to make it clear that they are seriously interested in doing that. And so far, the market is still waiting for that. The main pockets of buoyancy that were apparent in the Chinese equity market yesterday were those companies that were tied to DeepSeek and the China tech sector that was seen as potentially benefiting from China's apparent success in coping so well with the restrictions that have been imposed on what chips it could use. But for a broader market rally, you're going to need more than that. You're going to need the authorities in Beijing to come to the party in a way that so far they've been reluctant to do.
Catherine Reynolds, who leads our Markets Live Asia coverage there. Well, coming up on the Asia trade, we take a deeper look at how the US-China trade war will impact oil prices. Vectis Energy Partners will be with us, and StashAway joins us to discuss positioning for market volatility. Plus, we'll take a look at what's next for Asian chip makers with the Futurum Group. This is Bloomberg.
We're seeing mixed moves for tech stocks in late trade after Qualcomm and ARM gave divergent outlooks in earnings. Right now, we had Qualcomm gaining ground at first, but we're seeing the downside pressure right now as ARM holdings, of course, fell, given a disappointing outlook as well. Let's bring in our reporter Annabelle Drewlers for more. And Belle, let's start with Qualcomm because it gave a rosier outlook, and we had that after we're trading higher, but it seems that it's playing catch down with ARM as well.
Yeah, that's right. It's been pretty interesting moves in after hours, and it just tells you maybe investors are continuing to digest these results coming through and maybe starting to zero in on some things or hone in on some things that are causing a lot more concern. But at the headline level, actually, the numbers were pretty good, and we did see shares moving higher, as you say. So earnings per share, they were up 24%, coming in at $3.41. That was well above the consensus from Wall Street of $2.96. Revenue as well, that was up on an adjusted basis, but still up around 18% on the year, so coming in at $11.6 billion. The estimate had been for $10.93. And as well, in terms of what they're seeing for the quarter ahead, still, at the upper end of the scale, it's still coming in better than what Wall Street analysts had been tipping. But what is driving a bit of concern in late trade is this concern around the licensing business, or the licensing portion of the business. And this is going to be generating, they say, the company between $1.25 to $1.45 billion for the period. The average analyst projection had been for $1.4 billion. And so that is sort of causing a bit of concern also because of what it signals. This is based on a projection of the number of phones that are sold. And so it is causing some to say maybe the outlook for smartphone growth isn't looking so strong.
What else kind of stood out to you when it comes to that release?
Well, we had Qualcomm, of course, and it's sort of coming in a flux of a different number of earnings across the week, because ARM was another one as well. And this one we've seen, of course, is dropping in late trade. But essentially they gave a pretty cautious outlook for the current period. And that, of course, follows what we had from AMD that also gave a bit of a lackluster projection. And so in aggregate, again, it's not painting such a great picture. But revenue is going to be $1.18 to $1.28 billion in the fiscal fourth quarter. That ends in March. That is in line with some prior forecasts, but some analysts, again, have been tipping it to go even high. There's a lot of expectations that are on these companies as well. So, again, we've seen those shares dropping in late trade, but it is that concern around the outlook from the company.
And, Bill, we're also hearing that ARM's majority owner, SoftBank, is in acquisition talks for Ampere. What do we know?
Yeah, that's right. So actually, SoftBank still owns 90% of ARM, but we have been reporting at Bloomberg that there were these talks or discussions in place between SoftBank and Ampere for an acquisition. This has been something that's been going on for quite a period here, but the latest that we've got is that they could be discussing a deal that would value Ampere at $6.5 billion or thereabouts, and that would include debt. A transaction we're hearing as well, it could be announced in the coming weeks. We had been reporting on this expression of interest last month, but even going back a couple of years ago as well, in 2021, there were talks at this point as well. And what's interesting is the valuation that had been tipped at that point, which was around $8 billion. So coming down to what could be $6.5 billion now also just tells us how much increased competition there is in this space.
Our tech reporter Annabelle Droll is there with the latest. Let's get you caught up when it comes to some of the other corporate headlines that we're following this hour. And Tesla sales in Germany fell 59% last month, with less than 1,300 new cars registered for its lowest total since July 2021. That was when, in a market that we saw that EV sales overall jumped 54%. The company's struggles may be connected to Elon Musk's political activities. A YouGov poll taken in mid-January suggested many Germans viewed the CEO unfavourably. A group of Morgan Stanley-led banks have sold $5.5 billion worth of debt tied to Elon Musk's social media platform X, offloading around half the exposure they've been holding since the 2022 purchase of what was then called Twitter. Sources say the loan sold at 97 cents on the dollar. The banks still have $6 billion of X-related debt on their balance sheets. Google has told staff it will no longer formally seek to improve the diversity of its workforce through aspirational goals. It's just the latest tech giant to retreat from such initiatives since President Trump's election win. A note to employees says that as a federal contractor, Google is also evaluating recent court decisions and executive orders on the topic. More ahead on the Asia trade. This is Bloomberg.
We're watching Treasuries trading. Of course, we had Treasury yields declining in the Wall Street session. A weak reading on U.S. services pushing the 10-year yield down, supported on the other side by stronger than expected ADP private payrolls. But of course, there's also the Fed narrative, with the Fed's Austin Goolsbee warning that persistent tariffs could renew supply chain disruptions and drive up inflation. We'll discuss all of this and the macroeconomic picture globally coming up today on Bloomberg TV. Tomorrow on Bloomberg TV, we'll hear exclusively from Bank of Korea Governor Lee Chang-yong about Trump's tariffs, inflationary pressures on the Korean economy, and the chances of a rate cut later this month. More ahead on the Asia trade. This is Bloomberg.
Gulf Coast refiners actually run a lot of the heavy grades that come from Venezuela. If you see sanctions on Canadian or tariffs on Canadian or Mexican oil, that may send some of that oil to other countries. And so the Venezuelan oil could be even more important. So it's things like that. It's how would this work through the system that we really try to help the policymakers understand.
Chevron Chairman and CEO Mike Wirth there on the potential impact of US tariffs on oil markets. Take a look at what we've seen when it comes to some of the moves across crude markets over the last 2 days. Of course, so much of the geopolitical and trade tensions have played into the moves, and we've now seen that tariff threat has really encouraged Canada to rethink those limits on oil pipelines. So that's a potential factor there as well. But oil has fallen to that lowest settlement price of 2025 as traders exit the market after all of these Trump policies, the positions on the war in the Middle East, the tariffs on energy, all of this really weighing on sentiment. Let's get some more perspective now on oil markets. Joining us now is Tamar, Essner, principal at Vectis Energy Partners. Tamar, we've seen a $17 billion net outflow from crude and fuel markets globally. Do you expect this exodus to continue?
Yeah, I think that the uncertainty from Trump's announcements and policies and really the lack of understanding what his clear motivations are will lead investors to be uncertain and find oil increasingly uninvestable for the foreseeable future. And so that's a big overhang on the market, even if Trump ends up backing down on some of the tariff threats, as we've seen with Canada and Mexico. Just the overall market of uncertainty is not good when it comes to the outlook for demand, particularly in an environment where Chinese demand, sort of the linchpin of the demand growth story, is already under question.
It's clear that the direction of travel going forward the next few months is going to be lower, and you say political and geopolitical developments are going to be more important than fundamentals. What role then do you see as being played by OPEC Plus and allies?
Well, I mean, over time, we know that OPEC has significant spare capacity, anywhere 5 to 6 million barrels, depending on how you calculate that. And ultimately, we know that they want to bring those barrels to market. They've been fairly disciplined so far in sort of adhering to their deals with some exceptions. Obviously, Trump has called upon OPEC to add more barrels, and they've sort of pushed back on that. Ultimately, we think that there could be some sort of deal, I say in air quotes, where Trump can declare victory by OPEC saying that they'll add back barrels in April, which is sort of in line with what they are initially planning to do. Obviously, it will sort of depend on where prices are at the time. Over time, though, I mean, it really is, it's a difficult situation for OPEC because without the pressure from Trump, there really isn't much need for those OPEC barrels this year, the way we see balances, because in an outlook where demand is uncertain and supply growth is robust in and of itself, there really isn't room for the OPEC barrels. They may just take the out from Trump and add those barrels, start adding a small amount of those barrels back anyway, but it's a difficult position for them. And ultimately, it's sort of a threat to the OPEC cohesion unwinding over time.
What does that mean for Americans, for example, at a time when we're thinking of potential tariffs on Canadian oil imports? I know that those are on hold for the next month, but what happens afterwards?
Well, I mean, we'll have to see, obviously, particularly when it comes to Canadian tariffs. Ultimately, we think that those remain carved out, even if other tariffs on Canadian products end up coming online. We expect that somehow or another there will be an agreement to keep Canadian oil exempted, because there just really is no alternative for the 4 million barrels a day that the U.S. imports from Canada. And if those tariffs did come into effect, it would be tremendously disruptive for the U.S. Energy system and for consumer prices. So from just our conversations in the industry, we expect that there ultimately will be carve-outs for that. The main uncertainty right now is what impact this all has on the demand outlook from all of the economic uncertainty that this is creating.
Especially economies like China that have already been stuttering, but at the same time, we're seeing perhaps a little bit of a revival of consumption coming after the Lunar New Year holidays. How are you seeing demand from China coming in the next few months?
It's really such a gray area because any data coming from China, you really have to take with a grain of salt. It's just so uncertain. We expect that there will be a lot of noise around it. Obviously, the lower oil prices go, the more China starts buying for their strategic and commercial inventories. So we expect demand will look a little better amid lower oil prices. Of course, we won't get that data until several months delay. And obviously, the looser that they are with their refinery export quotas, they basically just end up exporting a lot of refined product back onto the market. So, over time, the clear picture direction of travel, as you said earlier, is for lower Chinese demand. The demand growth, at least, is going down. Their whole policy is based on a system of being more power dependent, so coal and renewables to fuel electric vehicles. And so oil is going to be less and less a part of that story, but amid that long-term trajectory, there will be a lot of noise and up and down with the Chinese demand data, and that could be a source of support for the market this year.
We saw a lot of support also for energy stocks in the past year or so, given the expectations of how much compute power it would take to really bring in the new era of artificial intelligence. But now you have China's startup DeepSeek that can do all of this at a low cost and more efficiently. Does that change your calculations at all on these names?
Maybe by degree, it changes in terms of just how much the demand expectations will be for more power. But ultimately, demand for power is going up. Clearly with electric vehicles, increased digitalization, data centers, even if DeepSeek's model ends up proving more scalable, demand is going to be higher for power. And so I think that that's a long-term source of demand, of support for natural gas stocks, particularly vis-a-vis oil stocks. So the problem right now is oil, as we said earlier, has kind of become underinvested and sort of uninvestable because investors just don't see long-term demand for oil. They're really concerned about that, terminal value issue. With the whole power demand story coming from AI and digitization and electric vehicles, you've sort of created a long-term thesis for natural gas stocks vis-a-vis oil. And so I think that that's a source of outperformance for those stocks.
Tamar, Essner, always good to have you with us. Principal at Vectis Energy Partners. We're not just watching oil, we're also watching the metal space because, of course, there are threats of tariffs on the likes of steel, aluminum, copper as well. We're also watching gold because it's hit fresh record highs. There's haven demand given all of the tariff news. Also, gold in the Bank of England trading at a discount to the wider market because of these fears of potential tariffs coming from the Trump administration. In the meantime, Arabica coffee, again, prices have doubled over the past year. We continue to see supply concerns, especially when it comes to Brazil, Vietnam, global stockpiles now falling to a 25-year low.
Well, Shery, Richmond Fed President Tom Barkin has joined other Fed officials in calling for more time to see where the U.S. economy and inflation are going under President Trump's policies. Barkin spoke exclusively with Bloomberg about the Fed's patient approach to rates.
The case for wait and see is, in fact, that you want to wait and see. I start with a baseline economy the data's been pretty favorable. We had a pretty good growth in the fourth quarter. Consumer spending's healthy. Inflation, especially the last 2 months, has come down, and I expect the 12-month numbers to come down nicely over the next couple months as we lap last year's elevated first quarter numbers. Job market seems to have stabilized. So I start with a baseline that's pretty favorable for what we're trying to do. And then you have uncertainty. And it could take us up, it could take us down. We'll just have to see.
Do you still see the Fed cutting at some point this year?
That's certainly the lean, but we'll see what happens.
Could the Fed potentially see anything that could cause you to contemplate hiking rates?
Well, I never take anything off the table, and so if you never take anything off the table, you can't take anything off the table. So I'm not going to do that. But you'd have to see an economy overheating, and I don't see any signs of an economy overheating. I see inflation coming down, not going up. I see the job stabilizing, but we got the JOLTS data yesterday. It seemed to come down a little bit. It doesn't feel like we're overheating, and I think you'd have to imagine you're seeing an economy overheating.
Let me go back to the base case idea. At this point, do you think that interest rates are suitable for this economy? For a while, the Fed was saying we need to cut because we're still tight. But if you can't, is that okay? Are you looking for data that will tell you to cut, or are you looking for data that will tell you to hold?
Well, so I supported the recalibration we did, obviously, in the fall, and that's because with inflation in the 2s and unemployment weakening at the time, the one number that seemed out of range was having the Fed funds rate at 5.3. So we've brought it down 100 basis points. It's at 4.3. I still think that's moderately restrictive, but we'll learn as we go. And if what happens is the economy comes back strong, you have to ask yourself questions about how restrictive you really are. If the economy weakens further, you can adjust appropriately. If inflation continues to come down, you could say, yep, I'm having the impact I want to have. If it doesn't, you ask yourself those questions. And so I think we've recalibrated to a place that is more sensible given where the economy sits right now. And I think it leaves us well positioned on whatever happens.
Richmond Fed President Tom Barkin speaking exclusively with our colleagues Michael McKee and Lisa Abramovitz. More ahead on the Asia trade. This is Bloomberg. Well, Honda and Nissan appear to be on the verge of abandoning plans to merge into one of the world's biggest car makers. A collapse in discussions would spell trouble for Nissan in particular, which was counting on its peer for a lifeline. Our global business senior editor Chester Dawson joins us now from Detroit. So what do we know in terms of the diminishing prospects of this deal coming through?
Well, it still seems like the negotiations are a little halting at best, and it's still somewhat unclear as to whether they're going to come to terms and become the world's third largest automaker, or whether this is all going to fall apart in a great ash heap. It seems like, for one thing, that the restructuring that Nissan has done to prepare itself to streamline maybe hasn't been quite sufficient enough to win over Honda. But it's very unclear whether these two companies are going to be able to come to terms, or maybe they're going to need some outside catalyst to come in and stir things up.
The idea was that if we got this alliance and this combination, that we could see potentially them rivaling Toyota, right? How is Toyota doing right now? We got their earnings.
Toyota's doing fine. I mean, it just keeps humming along. I mean, the latest quarter was fine. It didn't blow the lights out, but their full year forecast for the fiscal year that's through the end of March was good. It didn't quite meet some analysts' expectations, but Toyota is always very conservative with these things. If you look at their exchange rate, for example, and they're still recovering from a certification scandal or quasi-scandal earlier this year. So they're in great shape. They've got the hybrids doing well, and their vehicles, they're still the world's largest automaker.
Our senior editor, Chester Dawson, there joining us from Detroit. And it's a busy week of earnings here in Japan because we also have chip-making equipment supplier Tokyo Electron expected to report its highest quarterly operating profit in 2 years today, thanks to the boom in artificial intelligence. For more, let's bring in Bloomberg Intelligence senior tech analyst Masahiro Wakasugi. Masa, of course, we know that the results now look pretty positive, but always with Tokyo Electron, it seems to be about what happens in the future, especially if you have these tariffs against China as well. Not to mention DeepSeek, and I haven't even gone that far about more low cost-efficient AI.
Yeah, probably in this time, market focus will be again the revenue from China. So in the case of Tokyo Electron, their revenue exposure to mainland China was quite high. And the market may think that one of the big reason why Tokyo Electron is now reporting good numbers, but the market may be a bit concerned about the future demand reduction, potentially from mainland China. So the market focus could be something around the China-related demand. So the situation might be a bit different from Japanese suppliers and U.S. suppliers. So that could be one of the focus.
How well are they doing then in diversifying away from China? And adding to that, how much of an impact is for a semiconductor equipment supplier when we're thinking now that we could get cheaper AI models?
So probably in the case of Tokyo Electron, they are having a bit more demand from the kind of probing equipment, or apart from that, their existing main product is called a developer or etching machine. So they are kind of having more, broad-based products going forward. So maybe related with AI or AI-related processors. So actually, its peer Tokyo Semi reported quite good numbers. So maybe that implies that the Tokyo Electron will be doing quite good for the other products, including probing machines. And maybe if we talk about the AI models, we basically think that cheap or maybe cost-efficient AI models will promote more AI adoption going forward. So that will eventually create more demand for the semiconductors, and also the semiconductor equipment revenue should be pretty linked with the AI adoption going forward.
What are we watching for when it comes to China sales? Does that sort of give the possibility of upside or downside either way? And are some of those risks already priced in?
I think that mostly the market understands the situation. So in the case of Japanese makers, mainland China revenue exposure is around maybe 40-45% range, and in the case of U.S. makers, that should be around the 30-35% mark, revenue exposure range. So that should be the focus. So if the number is a bit too high, market may be a bit too concerned. Market may be concerned about the potential revenue decrease from mainland China next year. So I think the market should be looking at what percent of revenue coming from China in December quarter for Tokyo Electron.
Bloomberg Intelligence Technology Senior Analyst Masahiro Wakasugi here with what to expect from Tokyo Electron. As we get their earnings, we have more results coming out of Japan. Nomura's profit already being reported as rising more than expected in the quarter ending December. Net income at Japan's biggest brokerage doubled from a year earlier to over $660 million. Nomura reaped the benefits from robust trading and its investment banking business and made progress on cost cuts. Revenue at Nomura's domestic wealth management division also grew 13% for the eighth straight quarter. Ford shares fell in late trading after the automaker warned its profit this year may fall by around $2 billion. The initial warning pegged the possible weakness to falling vehicle prices at the same time it works through expensive new model launches. CEO Jim Farley told us that President Trump's threatened tariffs could also cost the auto industry billions.
I think longer term is the bigger concern. These kind of tariffs, especially in these two countries, are very significant. And if they persist beyond months, we could see billions and billions of dollars of pressure on the industry, lost jobs, lots of impacts to communities and our ecosystem in the industry. And that's what we're talking to the administration about and congressional leaders.
Disney CFO Hugh Johnston says that the Trump administration's tariff blitz is immaterial to the company. He also told Bloomberg why he's expecting continued growth for Disney's streaming business. That saw a 31% gain in first quarter earnings.
The streaming business is doing extremely well. This is a business we invested pretty heavily in a couple of years ago. And what you're seeing now is the benefit of those investments. Our expectation is we'll continue to grow subs, we'll improve margins. We should make more than $1 billion in that business this year, and next year we're looking at double-digit margins in that business. So certainly a ton of positive momentum. Now you get into the question of why. A lot of it is the great content that's coming from the studio side of the house, both on the TV and the movie side of our entertainment business. Moana 2, Inside Out 2, Deadpool, all terrific hits. And on the TV side, the combination of Abbott Elementary, Shogun, and High Potential, causing viewership to grow. We're seeing higher engagement. We're seeing churn ultimately coming down over the course of this year. So we feel like the streaming business is going to be one of the big drivers for our company going forward.
You know how much I love Shogun, and Lisa, I can say, loved Moana 2 as well. So the content slate is looking pretty good so far. I did want to talk about the cost issue, though, and clearly not an issue from you, so I appreciate the explanation. Conversation we've had over the last few days or so is if we get tariffs, can companies pass on the costs? I'd like to know from your perspective and for the company, the additional tariffs that have gone on to China, how that could impact your business. How are you thinking about things?
Yeah, right now, based on what's been proposed, and obviously this is a rapidly evolving environment, so we're going to react as we learn things. The impact would be immaterial to us. So from that perspective, really, the Walt Disney Company will be fine based on what's on the table right now.
Disney CFO Hugh Johnston speaking with Bloomberg's Jonathan Farrell. We have more ahead on the Asia Trade. This is Bloomberg.
The latest political stories from around the world now, and French Prime Minister François Bayrou has survived in 2 no-confidence motions in Parliament, assuring the passage of a 2025 budget following months of political turmoil. France is now on its 3rd government since President Emmanuel Macron called snap elections last year that fractured the National Assembly. French bonds rallied this week, although Bayrou describes the budget bill as imperfect. Sara Duterte has become the first Philippine vice president to be impeached by the House of Representatives. The move heightens political risks amid a public feud between her family and that of President Ferdinand Marcos Jr. Duterte will face a trial before the Senate, which could result in her removal and disqualification from holding office. Shery.
Take a look at the broader markets right now, trading across Asia. The ASX 200, and that's staggered open, saw the gains of 0.9% early in the session. Nikkei futures setting up for a higher open of 0.4% as well. We had a little bit of a mixed picture when it came to U.S. tech earnings that we saw. Qualcomm had a bullish sales forecast. ARM, though, tepid outlook. Both of them, though, falling in the after-hour session. So we're looking at those tech stocks in the Asia session, especially as we get Tokyo Electron's results today, expected to report its highest quarterly operating profit in 2 years. U.S. futures not doing much. As I said, it was a little bit of a mixed picture, but we actually did see U.S. stocks rising in the overnight session, with most major industries higher. The dollar falling to the lowest level in more than a week. A little bit of a different economic picture. Weak reading on U.S. services, but stronger than expected ADP private payrolls. So we'll be watching U.S. Treasuries trading at the same time. Also, the Japanese yen at the highest level since December against the U.S. dollar. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we keep an eye on those tech stocks. Of course, we had a mixed picture coming from tech earnings in the U.S. Haidi, we do have Tokyo Electron also earnings out today. But what we're also watching is really commentary coming from the Trump administration on the Middle East and the Ukraine war.
Yeah, and of course we continue to see the reaction to his plan for the US to take over Gaza reverberating around the world. There's been so much sort of ridicule and scorn and outrage over that plan, even as his own aides try to walk that back. So it'll be very interesting to see what sort of plan materializes when it comes to the future of Ukraine. And at the same time, we continue to see just a lot of uncertainty. For example, that USPS news, right, being walked back as well. So we could see some upside when it comes to some of those e-commerce stocks in China.
Yeah, we'll be watching that open after Chinese stocks took a tumble after coming back from the Lunar New Year holidays, really setting a different tone for the markets. But right now we're seeing Japan coming online, gaining ground 0.4% for the Nikkei as we're awaiting that Tokyo Electron earnings. Not to mention we already are reacting to earnings that have come out in the past week, including Nomura, Toyota as well. Not to mention that we're watching that potential tie-up between Nissan and Honda that could be facing a little bit of trouble at the moment. The Japanese yen strengthened in the overnight session. Look at that. It's at that 152 level, the highest level since December. We had the dollar falling on the other side of that trade because we had some conflicting numbers also out of the U.S. Economy, especially when it comes to that services data disappointment. But the 10-year yield, high levels, at the highest, I think, since 2011 or so. So do watch out for that because we are seeing those expectations for BOJ tightening continuing to rise. So we're seeing yields rising and the yen strengthening as well. Take a look at how the Kospi is coming online because we've been watching, of course, semiconductors, chip makers like Samsung, SK Hynix, the Kospi gaining ground at the open. The Korean won still a little bit weaker against the U.S. dollar. We heard from the South Korean government that they're expanding this huge fund. They're going to set up a new fund in order to be able to support those biotech names, those tech names as well, Heidi.
Take a look, Shery, at what we're seeing when it comes to the trading situation here in Australia. We're just about an hour into the session for the ASX. We're seeing upside of about 0.9%. If you want to take a look at a bit of a breakdown, most of that rise being left by the financials, the banks, property stocks as well. In New Zealand, we're seeing that session close today for a public holiday. We're also watching the picture when it comes to treasuries as well as sovereign bonds, right? In Australia, we saw that new bond attracting 83 billion Aussie dollars worth of bid. This is a record-breaking sale due to the central bank policy easing, moderating inflation levels, trade tensions as well. So we're seeing Australian bonds joining the likes of Spain, France, the UK and getting those record orders this year. At the same time, we're watching Treasury yields very closely, right? That slide to the year's low so far after with the drop that we saw in the services index, with most of those yields across the tenor falling around at least 10 basis points after the service sector activity gauge weakened more than anticipated. So really kind of firming up the view that the Fed interest rate levels will stay restrictive, perhaps strengthening the case for for cuts to come later this year, but certainly that sense of wait and see is still very much intact there. Let's bring in Stephanie Leung, who's a Chief Investment Officer at digital wealth manager StashAway. So, Stephanie, it's been a pretty chaotic week so far, pretty chaotic year so far as well. How are you navigating all of the uncertainty and the possibility that the news flow can kind of just be in such a whiplash sense of changing the narrative?
Yes, I mean, indeed, if we think about how long Trump has been in the office, it was just 2.5 weeks, but it felt like almost 2 years, I think. But I think it's important to remember a few things. The first thing is that there is going to be a lot of noise, and this was the Trump administration that we saw in 2016, and this continues to be the new Trump administration that we see right now. However, it's important to think about what are noise and also separate noise from actually real data. Indeed, if we look at real data, for example, when we look at the PMI data that just came out, I mean, global kind of industrial cycle has been improving. And indeed, it's been improving in the US. And particularly if you look at some of the, I guess, smaller cap companies and mid cap companies, they are reporting improvement in sentiment. And that gets actually reflected into better performance this year versus the broader S&P index. So, for example, if you look at the equal weight S&P or the mid-cap S&P, those have actually been outperforming the overall market. And I think you're seeing a bit of rotation here out of the popular stocks and popular sectors from last year into the broader market, which is something that we would like to see. So in the beginning of the year, we put out our outlook piece. It's called FAT is the New Normal, FAT. And the reason why we call it FAT is because, of course, we all like kind of a bit of more substance, especially around the Chinese New Year. But also FAT represents fiscal policy, AI, and Trump. And I think these three pillars are going to be kind of what we should pay attention to as investors in this year and perhaps in the next few years.
I'm curious, though, sort of, I guess, outside of that, are there domestic stories that you think might be less impacted and also make for compelling investment thesis?
Yes, and indeed, we are overweight India and Japan in our global asset allocation portfolio because of the fact that these are much more domestic stories. And for example, if you look at India today, it has suffered a kind of a correction in the last few months, but that is partly because of profit taking. I mean, India was, of course, trading at a much more expensive level in terms of price to earnings, but also, it has been one of the best performing markets in the past few years. However, today, with valuations actually back to a more normalized level, we think it's actually pretty interesting. particularly when I think if you look at some of the things that are going on domestically, the RBI is slated to cut in the next meeting. They just came out with a fiscal budget that is quite expansionary. They have, I think, they have much more political stability also in terms of the BJP winning in New Delhi election. So I think a lot of these things are quite supportive for the Indian domestic growth. And of course, I mean, given the correction we've had, I mean, now you're getting India equity at much more attractive prices.
Perhaps also that they're a little bit more away from potential direct tariffs coming from the Trump administration. Same thing for Japan.
Yeah, I think, of course, like the tariff story and also kind of the global cyclical cycle is much more relevant for Japan. But also, I think if you look at Japan from a longer term perspective, things like corporate reforms, things like coming out from deflation, and these are kind of multi-year trends that have not changed or will not change even with the Trump tariff. And then one thing that is important to remember, I think, is that when we look at the Trump set of policies, actually, we rank tariff at a much lower risk than I think what the market perceives. And that is because of a few things. Number one, if you look at the broad bucket of where Trump policies could land, of course, there are good, there are pro-growth policies like tax cuts or deregulations, but also on a negative side, potentially there is the tightening of immigration and also tariffs. And if we compare tariffs versus immigration policies, we think that immigration policies is actually a much bigger risk to the U.S. economy or to global economy than tariffs. Reason being, we think that if we look at the median voter in the U.S., they actually care a lot more about immigration than tariffs. And actually, if you look at the Trump kind of administration historically, they've used tariff as much more as a negotiation tactic than actually really bringing any kind of real blow to other economies. So we think that actually this is part of the tactics, and as we've seen in the past weekend, it is part of the deal.
StashAway CIO Stephanie Leung there joining us with the latest market outlook. Thank you very much as we're still watching trading here in Japan and those Asia tech names moving at the moment. Of course, we were watching SoftBank because ARM just disappointed and gave a tepid outlook, but also because we've learned that SoftBank is in advanced talks to acquire Ampere Computing. You can see a little bit of downside right there, but what we're watching is also Tokyo Electron because we are expected to see their results. They're expected to report their highest quarterly operating profit in 2 years. Of course, they're really riding that AI boom. Their demand for chip-making equipment continues to grow. Other chip makers, Renesas, Samsung at the moment also gaining ground. Take a look at how Nomura is doing because we have seen over 60% of companies here in Japan having beaten earnings estimates, especially financials have delivered their biggest beats. And you can see Nomura gaining 5%, their profit rising more than it had been expected. They benefited from robust trading, investment banking business, as well as making some progress on cost cuts. Haidi.
Yeah, take a look at autos in particular in Japan. That's one sector that we're focusing on. And there's sort of some deals uncertainty affecting the likes of Honda and Nissan at the moment. Interestingly, we're seeing Nissan up by over 2%. Honda, though, taking a dip by 3.7% there. We're hearing that deal to potentially merge would now be called into doubt weeks after those talks began. They're discussing options, including withdrawing entirely after an agreement to consider combining was called into question. That's really being seen as a big setback for Nissan, which has, of course, struggled with its leadership and competitive products over the last half decade. But interestingly, we're actually seeing Nissan stocks outperforming the broader auto sector at the moment. We're also seeing a bit of upside when it comes to Mitsubishi on account of the numbers, despite a profit expected to fall, but to keep that full-year target for the third quarter. And we're also watching Toyota there as well, off by just about 0.1%. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to crude and energy markets. WTI at the moment is looking like this after oil steadied near its lowest this year. The geopolitical positioning from President Trump, the threats of tariffs really weighing on the broader outlook, and we have seen a pretty immense drawback when it comes to investors that have gotten out of crude and fuel markets altogether. Well, the Trump administration is expected to present a plan to end Russia's war with Ukraine at the Munich Security Conference next week. It comes as President Trump's proposal for a US takeover of Gaza faces condemnation in the Middle East and among European allies. It's Bloomberg News editor Michael Haidi. So, I'm wondering, given the surprise that we had in, what I think his aides have since described as just creatively talking up possibilities, what we could expect for Ukraine.
Yeah, well, Ukraine's sort of slightly different because his envoy seems to be, President Trump's envoy seems to be taking more of a lead on that. And the discussion there also seems a bit more logical as well, and they're talking about strength through peace. And the outlines that we've got look reasonably straightforward. It's just that you'd freeze the conflict, that Ukraine would get a security guarantee to stop Russia from, taking the pause and then rearming or having another go at Ukraine. And then once the ceasefire's in place, Ukraine will hold elections. President Zelensky has said he's willing to sit down with Vladimir Putin, and Russia is sort of indicating the same. Russia maintains that President Zelensky's an illegitimate president because Ukraine's under martial law. Zelensky's terms actually expired, but under martial law you can't hold elections as well. Whereas Putin was re-elected with a landslide, to a fifth term in elections that no one believes were free and fair. So it's a bit of a furphy, that one. But nonetheless, all the pointers are that we are sort of making some progress. And for Ukraine, really, given they're on the back foot on the military side of things, they are struggling in general. I think that whatever they can get in terms of a security guarantee that means that they're not going to have Russia constantly coming at them, that would be something they were willing to take on. Just the final thing too is if there is an election and Zelensky did lose, a fresh person in charge of Ukraine always makes it easier for sides to negotiate if there's more details to do as well there. So I think that's why the US is quite keen on that front as well.
We've also seen a bit more reaction when it comes to the sort of maximum pressure campaign that we've seen Trump start to allude to when it comes to Iran.
Yeah, and I mean, it's interesting, isn't it? It almost looks like because just before he started talking about that he'd also be interested in doing a deal with Iran, he did sign into place those or look to impose those conditions, really strict conditions on Iran that would squeeze its economy, that would sort of replay what he did in his first term, and Iran's economy really did suffer then. But then he's come out and said that he's actually interested in a deal with Iran, just as long as it guarantees that it's willing to, it's not willing to progress to a nuclear weapon. So it's like he's sort of loaded the cannon or taken up the big stick, but now he's got out the carrot as well there. Now Iran's come back and said, well, we've never said that we were going to do create a nuclear weapon, and that this is a peaceful energy project that they've been working on. No one among the International Energy Agency or the nations involved believes that. But nonetheless, it's an interesting move by Iran by President Trump, because Iran's certainly on the back foot. There's no question here, geopolitically, economically. So if a maximum pressure campaign comes in, it's going to really hurt them. They can survive sanctions, we've seen that, but nonetheless, the temptation to take a deal now and to relieve some pressure on the economy and to get a chance to just recalibrate there, I think it would be very, very tempting for them. So yeah, there's a bit going on.
President Trump really seems to want to show the world that he's leading some of these conversations, especially when it comes to Gaza and the U.S. taking over, and that proposal that was welcomed by Israel, but perhaps not by any other stakeholders there.
Yeah, it's interesting, Shery, because, I mean, as Haidi alluded to, some of his spokespeople, and we had the Secretary of State as well, they've sort of gone back to the more basics there, that, of course, in order to, what President Trump was talking about was helping with reconstruction, removing all the rubble, the undetonated explosives, all that sort of thing. And they sort of draw a line along that as well, just these basic things. And obviously people can't live there while that's going on. But yes, you're right, the reaction was pretty swift. We've seen Saudi Arabia, we've seen Turkey, we've recently seen Egypt as well come out with strong opposition. And Egypt's basically said it's ready to come in with construction to get rebuilding Gaza and ensure that people do have a place to live and that services function. There's an interesting conspiracy theory that's going around. I was just reading in Haaretz, one of the newspapers in Israel, that perhaps Prime Minister Netanyahu was under a lot of pressure because we're sort of in these talks for a next stage of the deal on the ceasefire in Gaza, and that if he does go ahead with that ceasefire and doesn't resume the war, his government may fall apart. So President Trump has sort of come out with this dramatic statement, which obviously has been well received in Israel, and sort of moves the goalposts a bit in terms of those domestic political calculations. Now, as I say, this is just speculation as well, but it's sort of one explanation for such a dramatic move. With there's just so many different elements that suggest this is difficult and potentially would violate international law. And as you mentioned, I mean, France and Germany certainly came out against it, and France also has signalled its opposition. There's basically nobody internationally that's outside of Israel that's supporting this. But yeah, I mean, the idea of the US being involved, it's certainly interesting. And the key one here, of course, is Saudi Arabia too. Saudi Arabia was the first out of the blocks that said there must be moves towards a Palestinian state, that this is unacceptable to move these people out. And the Israel Saudi sort of agreement is what President Trump and what everybody's sort of after. The other issue too is that if you had this sort of thing that the US is talking about, there's every chance it further radicalises the populations in the Middle East, and that plays into Iran's hands. And Iran's on the back foot now, so you wouldn't really want to give it a helping hand here. And Saudi Arabia is very cognizant of that. So it needs to work very, very carefully here to sort of keep Trump focused on some sort of two-state solution and try and progress this agreement, because Saudi Arabia is trying to diversify from oil, so this is really important for it.
Michael Heath, Bloomberg News editor there with the latest on the geopolitical developments around the Trump administration. Of course, President Trump has also been busy on the trade front. China increasing its objection to the president's 10% tariff, filing a complaint at the WTO that calls for talks with the U.S. Our chief North Asia correspondent, Stephen Engel, joins us now from Hong Kong. Steve, excuse me, this reaction from Beijing was pretty much expected. But how are we expecting Beijing to proceed next?
Yeah, I think there's a wait-and-see approach right now, but clearly they want to take the multilateral approach, especially just as far as optics, saying, the United States on the unilateral approach to tariffs under Donald Trump is breaking WTO rules. And they followed through on their pledge as soon as that tariff was enacted to file this complaint at the WTO. They said the filing, the U.S. moves to slap China with 10% tariffs were imposed on the basis of unfounded and false allegations. It goes on to say that the measures at issue not only violate WTO rules, but are discriminatory and protectionist in nature. Now, keep in mind, China's reciprocal actions that were announced yesterday, there gives them still room to negotiate. But so far, because they take effect February 10th, so that's on Monday. But so far, even though we've gotten pledges that the two gentlemen you're seeing here would have a phone call at some point or imminently, they have not talked that we know of yet. Both sides probably would like to avoid an escalation, but they've sort of boxed themselves into corners, haven't they? At least the United States has, given that they have Donald Trump pledged even further action going forward, upwards of 60%, even higher tariffs. So there might be room to negotiate, but are they going to talk? Now, I want to bring up another point. China still, by having a fairly muted response yesterday, they have room to go further on agriculture, for one, on soybeans. Also, they're launching a potential investigation into Apple and the App Store fees. Essentially, sources are telling us that Chinese regulators believe Apple may be charging local developers unreasonably high fees, and that barring of the third-party app stores and payment methods also hinders competition and hurts local consumers. So this is something that's been brewing for a while, but now coming to the fore potentially as a lever that China can use.
There's been that reversal as well when it comes to the US Postal Service, first refusing Chinese and Hong Kong parcels and then very swiftly turning around and saying that they are again.
Yeah, that's right. There was 12 hours of confusion when we heard yesterday that the USPS, the United Parcel Service, essentially, in a one-line statement on the website, essentially blocking all packages, not letters, but packages from China and Hong Kong into the United States. And it gave no explanation. So there was tons of confusion. Of course, Donald Trump added to those 10% tariffs the removal of this $800 de minimis exemption for packages directly shipped from around the world, but mostly from China. In fact, there are 1.4 billion packages from around the world that used this de minimis exemption last year. That's about 4 million per day coming into the United States that didn't need to be inspected and did not have duties attached to them. Well, the USPS all of a sudden says, they didn't say this, I have to say, but apparently they went into panic mode because how are they going to comply? How are they going to enforce these new rules with such a deluge of packages that have been used by Temu, whether it's Shine, other direct e-commerce players into the United States? So 12 hours after announcing it, they've backed away. Now all packages and letters from China and the United States are coming from China and Hong Kong into the United States are being accepted. But it clearly shows the shock nature of the Trump tariffs and this immediate removal of the de minimis exemption that was supposed to be having a review process till about April 1st, but came sort of suddenly.
Our Chief North Asia correspondent Stephen Angle there with the latest. More ahead on the Asia trade. This is Bloomberg.
European futures looking like this in the Asian session. We had stocks gaining ground for a second day. Corporate results driving that upbeat sentiment. Novo Nordisk was one of them. Despite the tariff threats, we had seen several banks also reporting better than expected results. And coming up on Bloomberg TV, we'll hear exclusively from Bank of Korea Governor Lee Chang-yong about Trump's tariffs, inflationary pressures on the Korean economy, and the chances of a rate cut later this month. We have more ahead on the Asia trade. This is Bloomberg.
We do have breaking data just crossing the Bloomberg when it comes to Australian trade numbers for the month of December. Exports rising 1.1% month on month. Imports seeing a rise of 5.9% month on month. And we are seeing that trade surplus just shrinking to just over 5 billion Aussie dollars, 5.085 billion Aussie dollars from 6.5 billion Aussie dollars in the previous reading there. Of course, Australia is sort of in a sense at in the crosshairs of the global trade war and trade tariffs, particularly when it comes to the proxy impact through China. We have seen sort of Aussie assets struggling on account of that. The Aussie dollar not seeing too much of a move at the moment, and we are seeing broad upside today when it comes to trading in the equity session. The ASX being led higher by financials as well as some of the property names as well, up by just about 1% at the moment. The Aussie dollar holding at 62.84 at the minute, Shery.
Haidi, we're keeping an eye on those chip-related stocks in Asia, following, of course, earnings from Qualcomm and ARM overnight. Both companies ultimately fell in late trade. Our tech reporter Annabelle Drewlers joins us now with the latest. Let's start with Qualcomm because it was interesting how they reversed earlier gains in the after-hour session.
Yeah, and it really just tells you how investors were sort of highlighting different aspects of the earnings, because actually the numbers were pretty good for the quarter just gone. And in terms of the revenue, for instance, we saw that reaching $11.67 billion. That was well above projections of $10.9 billion. We saw earnings per share as well. That was a gain of around 24%. So that was some good things for investors to look to in the figures. On the flip side, though, where there is a little bit of concern is with the part of the business that talks about essentially the demand for smartphones ahead. So this is the licensing portion of it. They're looking at sales of around $1.25 billion to $1.45 billion for the current quarter, and that compares with an average analyst estimate of $1.4 billion instead. But as I said, the outlook for the licensing business in particular, it is based on a projection of overall outlook for number of phones that are going to be sold, and that is sort of sparking some concerns maybe that their industry outlook isn't too positive, and so that doesn't bode well for the stock.
What else kind of jumped out at you from that release?
Well, we had, of course, a number of different earnings across the week, or day rather, but ARM was the other one. So we had a cautious revenue forecast, and it's interesting as well when you see what we had from ARM. Of course, we had AMD earlier this week as well, and that wasn't too positive either. But essentially, ARM gave a pretty cautious forecast for the current period, so that does just add to this concern that spending on AI is going to be slowing. But revenue is tipped to be between $1.18 to $1.28 billion for the fiscal fourth quarter. That is sort of in line with a lot of projections, but it doesn't reach the loftiest that had been projected on Wall Street, which was for $1.33 billion. So again, it's just really as investors are trying to understand what is the spending outlook going to be, especially when you've had the likes of DeepSeek, for instance, being released just a couple of weeks back, but telling some investors that really it's possible to do the same amount of product, but just for less compute power.
We're also hearing that ARM's majority owner SoftBank is in acquisition talks for Ampere. What do we know?
Yeah, that's right. So this has actually been reported for a little while now, but it is seeming like it could come a little bit more to fruition. So essentially what we're hearing from people that are familiar with the matter is that SoftBank is in advanced talks now to buy Ampere. It could be at a valuation of around $6.5 billion. That would include some debt, and a transaction could be announced within the coming weeks. So this is sort of following on some Bloomberg reporting that we had last month as well. So the talks, we understand that they are in an advanced stage, but of course it's always that possibility that they delay or they falter. But still, it is interesting, that valuation of around $6.5 billion, because back in 2021 we actually had reporting as well saying that SoftBank was interested in taking a minority stake in Ampere at that point, but the valuation was at $8 billion. So it is a decrease in the valuation, but it does also tell us just how much competition there is in this space.
Annabelle Jewelers there with the latest on that sector. As we're now watching chip-making equipment supplier Tokyo Electron expected to report its highest quarterly operating profit in 2 years today, thanks to this ongoing boom in artificial intelligence. Let's bring in our technology editor, Mayumi Negishi. Mayumi, how are we expecting Tokyo Electron to fare? What will be the key metrics that you'll be watching?
Right. As you just said, analysts on average expect Tokyo Electron to report solid earnings for the December quarter, but I don't need to remind you that that's a past indicator. We're paying close attention to executives' comments on their outlook, the level of orders, what they're hearing on the ground from chip makers. And we just want to see how cautious chip makers are turning after DeepSeek showed that cheaper AI models are possible, and that maybe that market, the AI market, is going to become far more competitive and less lucrative going forward. We sort of, as you indicated earlier, that we've had some caution from the likes of ARM and AMD on their outlooks, and I think that kind of reflects how people are starting to digest the implications of models like DeepSeek coming out.
When it comes to specific markets, how closely are we watching the risks and also the numbers out of the China part of the business?
Yeah, so far Tokyo Electron's customers in China have been stocking up on some manufacturing equipment for fears of the export controls closing the doors shut That one-time surge in demand has largely settled down, Tokyo Electron has said last in the September quarter. But so we can get a better sense of how sustainable that Chinese demand is in the era of Trump. Tokyo Electron's customers kind of include Samsung, Intel, TSMC, SK Hynix, and basically, the main chip makers around the world. So we look at the orders to see where that demand is coming, where it's weakening. It's really a good way to see how sentiment is in the chip making industry.
Right, that was Mayumi Negishi, our Bloomberg technology editor. Let's get more perspective on the outlook for Asian chip makers amid Trump's tariff threats and, of course, everything that we've talked about, the jitters over AI asset pricing as well. Joining us now is Olivier Blanchard, Devices Practice Lead at the Futurum Group. Olivier, good to have you with us. I mean, we talked about some of the challenges that Tokyo Electron may face. Tell us your outlook about what can we expect from this result and just long term, given the potential tariffs as well.
Yeah, I kind of agree with, and by the way, thanks for having me. Good to be back. So I think, the order of the day, I think, is sobriety in any kind of AI-related markets. We've had, a lot of excitement in the last couple of years. We've seen the growth. We've seen this crazy demand for AI chips. But now I think the markets are settling down a little bit and realizing that it can't be a boom forever. Growth can be a little bit more sober, a little bit more relaxed, a little bit more realistic. So we have a few things going on at the same time. On the one hand, we have a lot of uncertainty in these markets, whether it's chip supply, export controls, the new Trump administration coming in and being, for better or for worse, a little bit chaotic. So it could be good, it could be bad. We don't really know yet. It's still an unknown quantity. But we know that the Trump administration does like to make deals. So there are always exits in case things get a little bit tight. But I think, I'm a little bit more cautious about Tokyo Electron and the Chinese market. I don't know that we're going to see the type of growth that we've seen in past quarters. And it's, for me, it's a little bit more of a gut feeling, just looking at a lot of different elements of this. We'll see. I think they'll have a good quarter, but I think we could expect a little bit of a slowdown in the next couple of months while things shake out. But generally, what I see is an expansion of the AI chip market that doesn't have anything to do with DeepSeek. I think DeepSeek was sort of the first warning shot of a bigger trend that's happening in AI, where essentially we're seeing models become much more efficient. And we're also getting chips that are becoming much more efficient. And so I think that the types of resources that we're anticipating a year ago to be able to achieve all of this AI capacity might actually be shrinking a little bit and expanding to the edge and out of the data center a little bit more than people anticipated.
So, Olivier, when I spoke to the Tokyo Electron CEO just recently, he was really talking about the potential long term. Take a listen to what he had to say first.
The importance of semiconductors remains unchanged. Given the global trends in digitalization and decarbonisation, there will always be investment opportunities somewhere.
You mentioned, of course, the potential of DeepSeek and the potential of lower-cost AI models to appear here and there. I wonder, though, what the impact will be on the dynamics of just broader chip development and pricing and what that could do for semiconductor equipment makers like Tokyo Electron.
Yeah, well, for Tokyo Electron specifically, everything's going to depend on its ability and the agility that it has in its pivot towards AI, right? So I think the next 6 months are going to give us a really good indication of where we'll be a year from now. So far, so good, but it's just going to matter. It's going to depend on Tokyo Electron's ability to execute quickly. And a little bit also on where we land with the AI chip exports and equipment exports to China. But I think what I feel encouraged by the fact that we're seeing a lot of the supply chain on the advanced AI chip manufacturing moving to the U.S. and expanding to other regions of the world and become a little bit more secure. So as the supply chain grows and becomes de-risked, I think that there's just less pressure on the United States to block China from acquiring certain types of technology that would allow them to make chips. So I think this will all settle. It's just a matter of when.
It's interesting you say that leads to sort of organically perhaps like less pressure. Is the reality more that with DeepSeek, if it is what it is claiming to be, we're seeing really the limitations of what even some very stringent curbs can do for innovation?
Right. Well, I mean, that's the thing about innovation. It just improvements keep happening. And they're not necessarily incremental. We could have incremental improvements in efficiency for the model training and for the chips for 2, 3, 4 years. But at some point, there's going to be a disruption, right? Where you're going to have an inflection point where you're making a forward leap that changes the dynamic a little bit. And I think that's technically what we're seeing broadly across the AI ecosystem. Chip makers are bringing extremely high power, low power, high output chips on the market for much smaller, more local solutions, whether it's an on-prem system or AI PCs, even AI-enabled smartphones are able to train and handle 13 billion parameter models and more. AI PCs are already at the 40 billion parameter model, and we'll probably get to 100 by the end of the year. So we're going to start seeing some of these systems happen, which sort of decentralizes the training and the inference workloads in AI. And so on the one hand, that puts less pressure on the data centers to handle it all. And that might mean a little bit less spend there, but it means more opportunity, more spend, and more competition in the broader market, right? The decentralized sort of hybrid AI market. So that's good for chip makers. That's good for any startup or any company and enterprise that wants to build its own tools. But I think that the markets need to understand that maybe they're over-indexing on the data center and under-indexing on the rest of the market, and sort of like take a step back and broaden the scope of the opportunity a little bit and not be so focused on data center, because the market is changing.
Olivier Blanchard, Devices Practice Lead at the Futurum Group. Really great to have you with us. More ahead on the Asia trade. This is Bloomberg. Well, China is calling for talks with the US at the WTO after President Trump imposed a blanket 10% tariff, and Beijing responded with targeted curbs of its own. But Bloomberg Opinion columnist Shery thinks that this time around Trump has the upper hand, and she joins us now from Hong Kong. And Shery, you're arguing that President Xi Jinping has squandered his most powerful trade war weapon. What is that?
In the global trade war, Haidi, the economy that has a more powerful consumer base wins. And that insight, it seems to have gone lost in Beijing. So let's see what they did after the 2018 Trump's first trade war. China doubled down on industrial policy, which is fine because they wanted to achieve technological independence and self-reliance. But on the other hand of the spectrum, basically the government ignored the welfare of the middle class. After a very brutal COVID lockdown, when China exited its COVID zero in late 2022, what Chinese middle class found was that the economy has long COVID. I mean, even today, we can see across China those unfinished property buildings left by distressed developers that have not been taken care of. And then young, fresh college graduates have no jobs, at least not very good jobs, because of the big tech crackdown. So what Chinese consumers have done is that they're hunkering down. They're saving a lot, even though there's hardly any interest to be gained from their savings. And instead, what China's economy has been relying on is basically exports, right? Like last year, when China achieved the 5% growth goal, private consumption accounted for only about a third of that 5% growth, whereas in 2018, consumption accounted for 2/3 of the growth. So basically, China has become more reliant on exports than ever. That's why Donald Trump has a lot more tools to basically pinch Xi Jinping at this point.
To be fair, the drive coming from Beijing was supposed to be to deleverage, to sort of try to really get away from all of that investment in infrastructure and a lot of spending that potentially led to a lot of just shell SOEs. How much of that has been achieved under Xi Jinping, especially at a time when perhaps he was not seeing another Trump presidency coming? Not a lot of us did, especially since most of the times the incumbent president in the U.S. gets reelected.
Right. To be fair to Xi Jinping, China's big tech was too strong in the economy, and there was too much leverage in the real estate market. But I think when they do the regulatory crackdowns, they also need to have a plan B, right? Like, it's about consumer rights. I mean, consumers bought those pre-sold apartments, and the government has to somehow deliver them when the real estate developers have gone bust. And so far, the property downturn is in its fourth year now. And so far, we have seen no solutions.
Bloomberg's opinion columnist Shery ran there from Hong Kong. Well, the legendary short seller Jim Chanos says President Trump's 10% tariffs against China won't make much of a difference for now, and investors need to wait to see whether the trade war escalates. Chanos spoke to us exclusively about Trump's move and Beijing's response.
I think China probably feels it was proportional, and we don't know what discussions are going on behind the scenes. So I think, again, wait and see. But I think that 10% isn't going to do it, by the way. I mean, getting back to our early conversation about the amount of tariffs you need to raise serious revenues, you know, you would have to raise them substantially on both China and the EU, and we haven't seen that yet. So we'll have to see what exactly comes within 30 days, 60 days. Mm-hmm. Does it escalate, or does it cool off? And it was an early campaign promise that he's delivered on, and now he's moved on to something else.
But at the same time, this comes at a precarious time for China's economy. You've been warning for a long time about China's debt bubble and its broken economic model. What does the imposition of tariffs, now at an additional 10%, but perhaps going even higher, mean for that long-term decline?
Yeah, it doesn't help it, that's for sure, because, I mean, China saw fewer reliance on net exports after 2010 when we first put out our warning, and that it's growing again. And part of that is due to the fact that the investment-driven model that we've been crying wolf about forever, albeit correctly, is losing its impetus to continue to grow. And the banking system is still bloated, and we've seen now problems in the residential real estate area completely trickle down into the actual developers. So they've got a model that really now is facing kind of a crossroads with what they're going to do. And the U.S. putting on major tariffs to one of their few thriving parts of the engine, the export manufacturing area, isn't going to help.
Jim Chanos there speaking exclusively with Bloomberg's Scarlett Fu. We have more ahead on the Asia trade. This is Bloomberg. Take a look at some of the stocks moving on the earnings season here in Japan. More than 60% of companies have beaten earnings estimates. Financials and consumer discretionary delivered the biggest beats. And you can see there Nomura gaining more than 7%. Their profit rose more than analysts had expected, benefiting from robust trading, investment banking. Also, they had some progress on cost cuts, revenue from the global markets business rising almost 40% from last year. Take a look at Toyota, a little bit of upside right now. They've raised their annual operating profit outlook to 4.7 trillion yen. They have revised their forecast, and this really reflecting the capital expenditure that they're expecting. They're also seeing some better cost competitiveness as well. But of course, we're watching these car makers given tariffs and the potential of those costs also coming from the Trump administration and their exposure to China, but also Mexico. Renesas, a big jump there. They had also earnings beating estimates, especially when it came to their fourth quarter net sales. We're watching semiconductors. Tokyo Electron expected expected to announce earnings today, and they're expected to report their highest quarterly operating profit in 2 years. Artificial intelligence, the boom continues, and that's really spurring demand for their chip-making equipment, Haidi.
Yeah, Shery, take a look at how all of this is feeding into futures, the picture as we get into the start of trading in Greater China there as well. It does look like a pretty positive day, and you know, the start of the year of the snake when it comes to Chinese equities was a difficult one, but we could see some further tailwinds there. That reversal of the decision to halt shipments from China and Hong Kong by USPS should see some relief when it comes to the e-commerce sector, the likes of PDD, for example, and some of those other related names. And we could also see a little bit of upside when it comes to tourism, hospitality, those sort of related names, given that we saw signs of a surge in holiday spending and some domestic travel upside there as well. Despite that broader sentiment for Chinese equities looking weak, we're also watching the yuan fix today, given that the previous one sent something of a soothing signal amidst these tariff threats that are ongoing. That is it for the Asia trade. Our markets coverage continues, taking a look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The Chanos show is next. This is Bloomberg.